Jerome thought he had finally made it. 7 years of grinding, 7 years of early mornings, late nights, missed weekends, and decisions that kept him up staring at the ceiling, wondering if he had made a mistake, leaving his warehouse job to go out on his own. 7 years of building something from nothing. And now, he was sitting across from a loan officer at the same bank he had banked with since the day he opened his business. The same bank that had his checking account, his business savings, and every single deposit he had made for the last 7 years. The loan officer smiled politely, shuffled some papers, and said the words Jerome had never once considered he would hear. "We are unable to approve your application at this time." Jerome sat very still. He had $1.4 million in revenue the previous year. He had 12 trucks on the road. He had contracts with 2 regional distribution companies and a national retail chain that had just renewed for a third consecutive year. He had never missed a payment on anything in his life, and the bank had just told him no. He drove home in silence that afternoon and sat in his driveway for 20 minutes trying to understand what had just happened. He had done everything right, and it had not been enough. What Jerome did not know, what almost no business owner knows until it happens to them, is that the bank was not evaluating his business the way he thought they were. He walked into that meeting thinking the bank would see what he saw. 7 years of growth, consistent revenue, real contracts, real clients, a business that had survived a pandemic, a supply chain crisis, and fuel prices that nearly broke him twice. He thought the bank would see proof. What the bank actually saw was a checklist. And Jerome's business, profitable, growing, legitimate, failed that checklist in ways he did not even know were possible. This is the story of what that checklist actually contains, why it exists, and why the banks will never sit down and explain it to you. Because if they did, you would not need them. Let's start at the beginning. Jerome started his trucking company with 1 truck, a CDL license he had earned at night school, and a $12,000 personal loan from his uncle. He ran regional freight in the first 2 years. Small loads, local manufacturers, nothing glamorous, but consistent enough that by year 3, he had added a second truck and hired his first driver. By year 5, he had 6 trucks and a dispatcher. By year 7, he had 12 trucks, 22 employees, including drivers and support staff, and a dispatch operation running out of a leased warehouse space on the south side of the city. Revenue in year 7, $1.4 million. Net profit after payroll, fuel, maintenance, insurance, and lease, $187,000. On paper, Jerome looked like exactly the kind of business a bank should want to lend to. Established, profitable, growing. He needed $280,000. 2 reasons. First, he had an opportunity to purchase 4 additional trucks to fulfill a new contract with a national retailer who wanted to expand Jerome's routes into 2 additional markets. Second, one of his existing trucks had been in a collision and the insurance settlement was taking longer than expected, leaving a gap in his fleet capacity during one of his busiest quarters. He needed the capital to move fast. The retailer had given him 60 days to confirm capacity, or they would expand with a competitor. Jerome went to the bank confident. He left confused. Here is what the loan officer saw that Jerome did not. The bank's underwriting process is not designed to evaluate a business the way an investor would. An investor looks at trajectory. They look at contracts. They look at the people running the operation. They ask whether the business is worth betting on. A bank asks one question above everything else. If this business cannot pay us back, what can we take? That is the entire logic underneath the checklist. Every document they request, every ratio they calculate, every box they tick or fail to tick, All of it is designed to answer that one question. Not, is this business profitable? Not, is this business growing? Not, does this business owner have a track record? But what do we get if it all falls apart? Jerome's business had $1.4 million in revenue, but the bank looked at his net profit of $187,000 and applied a debt service coverage ratio, a calculation that measures whether your net income is sufficient to cover the proposed loan payments with room to spare. Most banks require a ratio of at least 1.25, meaning for every dollar of loan payment, you need to demonstrate $1.25 in available net income. Jerome's numbers were close, but after accounting for his existing obligations, the lease, the insurance premiums structured as financing, and 2 truck notes already on the books, his debt service coverage ratio came in just below the threshold. Not dramatically below, just below. To Jerome, that felt like a technicality. To the bank, it was a hard stop. But the debt service coverage ratio was not even the biggest problem. The bigger problem was collateral. Jerome's 12 trucks were his most valuable assets. He owned 6 of them outright. The other 6 were financed. The bank looked at the 6 he owned outright and assigned them a liquidation value. Not the market value, not the replacement value, but the value they could recover if they had to repossess and sell them quickly. Liquidation value on commercial trucks is typically 60 to 70% of market value. 6 trucks at an average market value of $85,000 each. Total market value, $510,000. Liquidation value at 65%, $331,500. Against a $280,000 loan request that looked sufficient on the surface. But the bank also required that the collateral not be encumbered by other obligations. Jerome's 6 owned trucks were listed as assets on his balance sheet, but 2 of them had mechanics liens filed against them from a repair shop dispute that was still being resolved in small claims court. Liens the bank discovered during their title search. Liens Jerome had not thought to mention because in his mind they were a nuisance, not a financial issue. To the bank, they were a collateral problem. Suddenly, the unencumbered collateral pool dropped from 6 trucks to 4 trucks. 4 trucks at liquidation value, $221,000, against a $280,000 loan request. The collateral no longer covered the loan. Combined with the debt service coverage ratio that was already borderline, the loan officer had no room to approve. He apologized, shuffled his papers, and Jerome drove home in silence. There is a third thing the bank saw that Jerome had no idea was even being evaluated. Business credit, not personal credit. Jerome's personal credit score was 718. Solid. He had checked it himself before walking in. Business credit is an entirely separate system. It lives on separate bureaus. Dun & Bradstreet, Experian Business, Equifax Business. It is built through a completely different set of behaviors than personal credit, and it is one of the primary lenses through which commercial lenders evaluate a business before a human being ever reads the application. Jerome's business had no meaningful business credit profile. Not because he had bad business credit, because he had almost no business credit at all. 7 years of revenue, 7 years of paying vendors, suppliers, fuel cards, and insurance premiums. And almost none of those payment relationships had been reported to the business credit bureaus, because Jerome had never set up the accounts in a way that would generate reporting. His personal credit score was doing the heavy lifting in every financial relationship his business had, which meant, from the bank's perspective, the business itself, as a standalone entity, was essentially invisible. A business with $1.4 million in revenue and no meaningful business credit profile looks, to an automated underwriting system, like a brand new company. Because in the system's memory, it practically is. Jerome had built a real business, but he had not built a fundable one. And those two things are not the same. He spent 3 days after the rejection going over everything. He called a business advisor named Clifton, who had worked with trucking operators for 15 years. Clifton listened to the whole story without interrupting. Then he said something that reframed everything Jerome thought he understood about money and business. Jerome, the bank didn't reject your business. They rejected your file. Those are two completely different things. Your business is real. Your file didn't tell the right story. Jerome leaned forward. What do you mean, the right story? Banks don't experience your business. They experience a document. Your revenue, your profit, your contracts, your track record, none of that exists to the underwriter unless it shows up correctly in the file. The liens showed up. The coverage ratio showed up. The thin business credit profile showed up. The rest of it, 7 years of hustle, a national retail contract, 12 trucks on the road, that's invisible unless the file reflects it correctly. Jerome was quiet. So I lost $280,000 in capital because of 2 mechanics liens and a credit profile I didn't know I needed to build. You didn't lose it, Clifton said. You just went to the wrong room. Clifton explained what Jerome had never been taught. There are 2 completely different lending worlds. The first is the bank world. Slow, collateral-driven, designed for businesses that already look a certain way on paper. Businesses with clean balance sheets, established business credit, adequate debt service coverage, and unencumbered assets. The bank world rewards businesses that have already arrived. The second world evaluates businesses differently. Revenue-based lenders and working capital providers do not lead with collateral. They lead with cash flow. They look at bank statements. They look at deposit consistency. They look at how much money moves through the business account every month and whether that pattern is stable enough to support a repayment structure tied directly to revenue. Jerome had deposited over $110,000 a month on average for the previous 12 months. To a revenue-based lender, that was not a thin file. That was a track record. Clifton helped Jerome apply through an alternative lender that same week. 3 months of bank statements, a 1-page application, a phone call the following morning. By Thursday, Jerome had an offer, $280,000. Repayment structured as a fixed daily percentage of his deposits over 8 months. Total cost of capital, $47,600. Jerome looked at the number and did the math Clifton had taught him. The new contract with the national retailer would generate an additional $380,000 in revenue over the next 12 months. The cost of the capital to fulfill it, $47,600. The return on that $47,600, more than 7 times. He signed. The 4 new trucks arrived the following week. He confirmed capacity to the retailer with 11 days to spare. The routes launched on schedule. And 8 months later, as the last repayment cleared, Jerome sat in the same driveway where he had parked in silence the day the bank said no. He thought about what that rejection had actually cost him. Nothing. Because the right capital had arrived anyway. Just not from the place he had expected. Here is what I want you to understand from Jerome's story. The bank did not reject him because his business was weak. The bank rejected him because the bank system is not built to see what Jerome had built. It is built to protect the bank, to recover collateral, to minimize exposure, to serve businesses that already fit a very specific profile. Jerome's business was real. It was profitable. It was growing. It just did not fit the profile. And that is not a flaw in Jerome's business. That is a flaw in the assumption that the bank is the only room where capital lives. There is another room. A room where your daily deposits are the application, where your cash flow is the collateral, where a profitable business with consistent revenue is not a borderline case. It is exactly the profile they are looking for. Jerome found that room 11 days before he lost the most important contract of his career. You do not have to wait for a rejection to find it. If you are running a real business right now, consistent revenue, real clients, real cash flow, and you have ever wondered whether capital was available to you outside of the bank's checklist, the link in the description connects you directly to David Allen Capital. They do not start with your collateral. They start with your cash flow. No hard credit pull to check your options. Decisions in 24 to 48 hours. Funding based on what your business is already doing, not what a loan officer decides it looks like on paper. Check the link below. And if this video helped you understand something the bank never bothered to explain, subscribe to Smart Growth Logic. Because this is what we do here. We show you what the other room looks like. See you in the next one.